Big news. Capital One is buying Discover in a massive $35 billion deal. But is there still an opportunity to profit before the merger? Discover stock, DFS, is still trading below the buyout price, making it an interesting play for 2025. Along with this, the Credit Card Competition Act could shake up the entire industry. In this video, I will cover Discover's financials and valuation, the Capital One merger and how it affects DFS stock, the Credit Card Competition Act and its potential impact, and other risks and key takeaways. Discover is one of the top credit card issuers in the US, founded in 1985. It operates on a closed loop system, making it different from Visa and MasterCard. And it also has been recently expanding more into personal loans and digital banking. Discover's earnings has also shown positive results recently, reporting after hours on January 22nd, rising the stock price by 1.75% from $197 to $204 of share price, after rising 15.45% year to date, equal to a $27 increase at its current price of $201 as of February 6, 2025. This comes after a compound growth of 89% the past year, with a $95 increase in share price. Since then, Discover has reported successful earnings. The most recent in January found that DFS Discover reported a net income of $4.5 billion for the full year of 2024, with earnings of $17.72 per share. DFS successfully completed the sale of its private student loan portfolio, resulting in positive benefits in a streamlined business model. There was also found to be a net interest margin, which has been expanding, ending the quarter at 11.96%, up 98 basis points from prior year, showing great opportunity for continued growth, accelerating in 2025. Average customer deposits increased by 10% year over year, enhancing the company's funding mix. Discover also made significant progress in risk management and compliance, meeting regulatory requirements and resolving carbon classification issues as they arose. And here you can see the past earnings reports and how they perform versus the estimates. So for a little bit in Q1 of 2024, it seemed like Discover was a bit on the decline, but after news had come out in around February of 24, news came out of Capital One and the acquisition. So Discover since then has been skyrocketing. It skyrocketed in Q2, came back down when it was a little bit of a correction in earnings, and now it's still been reported to be growing. And based on the estimate here, if Discover lands where it is consistently in next quarter, whether it be under Capital One or not, we could see some really good performance and a result of an increase in the share price. Also, comparing Discover to other competitors, Discover has a $50 billion market cap and at a $201 price. Right now, Visa has a $678 billion market cap, significantly higher than Discover at a $347 share price. MasterCard has a $519 billion market cap with a $566 share price, and American Express has a $224 billion market cap with a $318 share price. Up next, I'm going to talk about the Capital One merger and what it means for Discover investors. Some details behind the deal. Capital One announced it will acquire Discover for $35 billion around this time last year. If approved, Discover shareholders will receive one share and a fraction of a share of Capital One per Discover share. So currently, Discover's price versus Capital One's buyout price, there is a premium of about $5 to $6 between that difference. So when Capital One and Discover do eventually merge, Discover's performance will be merged into the company, but not just that, you will get a little bit more of your money's worth immediately with your share amount. As you transfer over, you get 1.01 shares for every Discover share you have to Capital One. Why this deal matters? This could create the largest U.S. credit card issuer after JP Morgan Chase. Discover investors could see longer and stronger returns if the stock price continues to rise towards the buyout premium. But there is some issues here, potentially, if the deal fails due to regulatory concerns. Right now, it looks like it would be okay, but later in this video, I'm going to be talking about the Credit Card Competition Act that could throw a wrench in this acquisition plan, as the government looks to increase credit card competition and release some of the centralization that's been building up with Visa and MasterCard, and adding Discover and Capital One into one entity may be a threat to this, or it could be a positive. There's two scenarios here. So interested to see how this goes forward and to Discover remaining a strong standalone company, regardless if this does not go through. But that's more of a long-term turnaround. So it'll be interesting to see how this plays out. So why is Discover a strong buy? It has strong fundamentals and profitability. Discover continues to post strong revenue growth and solid net interest income. It has lower charge-off rates than many competitors, making it more stable. It is also undervalued with a solid dividend. DFS trades at a lower PE ratio compared to Visa and MasterCard significantly, showing it still has room to grow, especially with this merger. It also offers a 1.39% dividend yield with consistent payout growth, and the dividend grows year over year. Slightly, but it's growth. It also has aggressive share buybacks, boosting shareholder value. And DFS price targets recently, after earnings last month, were raised from $193 to $210 per share at RBC Capital and $233 to $262 at Truist. This just kind of reflects this growth moving forward and how much of a game changer this could be. Talking about game changers, the Credit Card Competition Act. What is the Credit Card Competition Act? Credit Card Competition Act is a proposed U.S. bill back from 2023, and it's looking that it will come up in this session as well in 2025 that would force major banks to allow multiple payment networks on credit cards, while also reducing interchange fees. How could this potentially affect DFS and Capital One? DFS is a closed loop system like AMX, meaning it relies on its own payment method and network. If this law passes, it could force Discover to open its network to competitors, reducing its pricing power. Visa and MasterCard, though, would be hit a lot harder. Discover and Capital One, alongside each other, could be the third main option for consumers and retailers to go to and could accelerate the price in 2025, 2026. I know that Vice President JD Vance has previously helped out and aligned alongside the Credit Card Competition Act, being one of its advocates. So it'll be interesting to see if he upholds that in this new administration. But Discover, regardless of this, could still face revenue pressure. With the Capital One merger, this could mitigate most of these risks. And if this bill passes, it could also put pressure on everyone's transaction fees. This could also get rid of some rewards and could seem harmful to consumers, but it could bring overall prices and inflation down as a lot of companies are spending millions and billions of dollars to these two massive companies that basically hold a monopoly of the whole industry, that being Visa and MasterCard. So, lots to consider moving forward. Some other potential threats for Discover are regulatory scrutiny on the merger. The government may block the deal due to antitrust concerns, economic downturn risks. Currently, there's a lot of uneasiness around AI. A lot of people believe we're in a tech bubble right now, similar to the dot-com bubble of the early 2000s. So we could see some shakiness there that would pull Discover down on a macroeconomic level. A recession could also increase credit card defaults and impact earnings. Credit Card Competition Act, as I mentioned earlier, there's a lot of uncertainty around the bill's passage and could create market volatility. And also earnings recently, there was some negative aspects that came from it. Discover card sales declined by 3% from prior year due to tightening of credit actions. Total operating expenses increased by $67 million, equal to 4% year over year, driven by higher compensation costs and merger expenses related to Capital One's acquisition deal. Net charge-offs were 4.64%, 53 basis points higher than prior year, indicating increased credit losses. The company also restated financial results dating back to 2021 due to reclassification amounts and card tiering accrual. Independent review found around $60 million worth of charges related to card product misclassification impacting financial results. So these are just some things to take into mind as you look to invest in DFS. Obviously, this is not professional financial advice, but do your own due diligence out there. And I mean, I personally am buying, but be careful and be smart. Overall, I am giving Discover a high buy rating. DFS is still trading below its buyout price, offering a potential premium if the deal goes through. It still remains a strong stock, even if the merger fails, thanks to profitability and its high dividend. The Credit Card Competition Act adds some uncertainty, but there are positives and negatives that come from it in the long term, and outlook currently still remains strong. What do you think of Discover stock? Do you think the Capital One deal will go through? Drop a comment below. Don't forget to like, subscribe, and turn on notifications for more stock analysis and call outs in the future. Thanks for watching.